Next up, why I moved to Miami. Starting up, David Koretz, founder and CEO of Plum.
So Dave might be right. Most entrepreneurs, myself included, might be liars and full of shit. But I would say that most investors and venture capitalists I meet are both full of shit, and even a greater percentage are useless. I'm going to talk a little bit about why I moved to Miami. By the way, I just finished 4 days at the TED conference and took a 15-hour red eye to be here. So by body weight, I'm mostly bourbon and red wine at this point. So I've never needed note cards to tell my own personal story before. But anyway, I am founder and CEO of Plum. But by background, I've done many, many businesses. I started my first when I was 14 years old. I sold it when I was 17. When I was 19, I had the dubious and embarrassing distinction of being Teen People Magazine's 20 Teens Will Change the World. And I think we can all agree there's no better gauge for the quality of an entrepreneur than Teen People Magazine. But let me talk a little bit about what I saw in Silicon Valley and some of the dangerous things I saw happening in Silicon Valley culturally that actually led me to move to Miami. But by background, most recently, I was the founder and CEO of Mykonos Software. Mykonos was a company that did intrusion deception for cybersecurity, stopping hackers from breaking into governments, e-commerce websites, banks. We sold it for $100 million to Juniper Networks in 2012. I started in 2010. We did our Series A on January 10th, 2012 at a 10 million pre-14 post. We sold it 33 days later for just under 100 million. So it was 600% cash on cash for my Series A shareholders in 1 month. I think the IRR was a little over 500 million%. Last month, I made the decision, back in March actually, I made the decision to retire from Juniper after 2 years running advanced technologies and then ultimately products and strategy for the whole security business, and decided to move here to start my next company. And so I went around the valley talking to all these friends of mine in venture capital, and I asked them what they thought of it, and I wanted to share some of the feedback. Now, I'm raising VC soon, so I decided to keep the guilty anonymous because a lot of them will be investors. The first famous VC just said to me, "You're having your odds of success by moving there." I then went to a next VC and got an equally positive comment. He said, "It's like you're willingly moving from the major leagues to a farm team." But perhaps the best comment came from another VC and sort of asshole who said to me, "I would fund anything you do, but not if you're going to wear a white shoes and a members only jacket while you do it." So it wasn't a positive reception. You can imagine how much more positive it got when I decided to tell them I was going into the wine business. So the response I got was, "You literally picked the worst industry I could think of." By the way, he actually is pretty good. So that said, and I'll get back to that in 1 second, the thing to me that I always found crazy about venture capital is that by definition, it's a contrarian investment, right? Every one of us that has done even the most basic investing theory knows that as you make investments, returns normalize over time, people rush in to fund the same thing, and eventually you end up having returns go to zero. Yet every venture capitalist that I know of, with very few exception, are 30 to 50-year-old white dudes that went to one of two colleges and pretty much wear the same outfit. So all I'm saying is if we're going to agree that we should think different, we should maybe at least start by dressing different. But that said, if you look at great investments, they're always contrarian over time. By the way, quick aside, I am pacing the stage, and I'm doing that for two reasons. One is I made a bet with one of the guys in the room about who would make more steps by the end of April. And so each of these are really progress against that goal. But if you look at the contrarian side of it, nobody was excited about the taxi business before Uber. Nobody was excited about investing in your homemade shitty handicrafts before Etsy turned it into $1 billion business. Nobody that I can think of was excited about renting out your fucking couch before Airbnb came in and it turned it into a $10 billion business. And yet, what happens in VC? Nobody's interested in investing in those until there's already a successful startup in there, and then they rush in to follow and fund the other competitors. That is the dumbest idea you can possibly think of. If by definition you're going to make all your money on the lead company, then you actually need to be finding the investments before somebody goes into them, not funding the also-rans. By a show of hands, can anyone name the next successful company in the auction space after eBay? Because by my math, there fucking wasn't one, right? There was one, and then there was a lot of very second-tier players at best. So I wanted to spend a few minutes talking about what I saw in Silicon Valley that made me move out and come to Miami. And this is going to sound odd coming from an entrepreneur, but the thing that scared me more than anything else happening in the Valley right now is around this idea of growing check sizes. I've had VCs say to me, look, I can't put 4 million in, but what if I put in 10 million and we raise the pre-money so the dilution's the same? Think about the logic of that math. You're financially making a worse investment for your fund intentionally. Why would you do that? And it turns out there's a few reasons driving it. The real reason is that as these fund sizes have gotten bigger, the limit on most limited partners and most investors and general partners in the fund is time. They only have so many boards they can sit on. And so what happens is it's a lot easier to cut a $20 million check and sit on one board than cut 10 $2 million checks and sit on 10 boards. And so check sizes, as you'd expect, are going up. And the number of, as the deal sizes and as the general limited funds go up, so are check sizes. Here's the problem I have with that. Every entrepreneur I've ever met worth his salt knows this secret. Too much money kills companies. It's death by 1,000 paper cuts. The more times that you have cash, and I've been in businesses that have been overfunded, I've been in businesses that have been underfunded. Historically, I've always found the same thing to be true. The more money I had, the harder it was to drive discipline across the organization. It's too easy to cheat. It's too easy to go faster. The second problem is that what's happening in the Valley right now is that we're seeing an enormous decline in close rates on new talent. I'm talking to entrepreneurs who are seeing 15 to 20% of the candidates they make offers to accept the offers. And these aren't the shitty ones. These are companies with tier 1 VC funding. They've got reasonably good business prospects. They can't close candidates. If you've ever tried to build a business, and especially in the early phase where you're trying to build a product, if you can't hire and retain engineers, you've got absolutely no shot at success. And so I think right now that's really an issue. But there's one thing that's more egregious for me than anything else. And I know this is contrarian to what a lot of people believe right now, but this weird fixation on unicorns has gotta fucking stop. It's odd to me that we have an entire industry of people focusing on mythical creatures. So I wanted to run the numbers by you real quick so we can at least agree what we're acknowledging when we talk about unicorns. There are a little over 1,300 venture capital firms that are active in the US at this moment. In any calendar year, they write about 4,000 checks in aggregate. A lot of those are going on as follow-on rounds to existing companies, about 1,100 new companies. Statistically, if you go back to the Venture Capital Association, you look at the returns between 0 and 6 in any calendar year, depending on the year of the economy and the number of companies, will get to a unicorn size. 0 to 6. They write 4,000 checks, and it's 0 to 6. So if we do the math and we overestimate and we say there's 10 venture capitalists in every single unicorn, and then we go a step further and we say they only take 5 years to get there, by my math, that's less than 1 in 250 people that will actually touch a unicorn. Or put another way, you got a better chance of living in the fucking castle in the background than you do in betting on a unicorn. So the idea that we're going out and intentionally killing $100 million exits in this bizarre pursuit for billion-dollar exits makes no sense. And I've seen it myself firsthand. What you have in the Valley right now is money is going at a faster pace than businesses can grow. And there is a limitation that every entrepreneur that has any sense knows. You can't get market fit faster and buy your way into it. There are limits to how fast you can build a product. You cannot solve those problems with dollars. What you do with dollars is you allow yourself to make a lot of shortcuts really quickly. Inevitably, when you have to make that hard decision between making one bet or making 3, if you've got enough cash, you don't. You make all 3 bets every time. That's a really dumb idea if you're sitting in my chair, because all I'm doing is upping my odds of success. The other thing that happens at the same time is that all of a sudden, $100 million exits look not palatable. I'm on boards and I've funded companies that have no revenue, have not released a product in GA, and have more than $30 million in VC. at valuations and pre-monies touching $100 million, which means they can't sell for $100 million because they've raised money at $100 million. If you drive up your pre-money too early, all you're doing is closing the door to the exit that is most likely. Unicorns is not likely. In an average calendar year, there's about 80 companies that sell for $100 million and 0 to 6 that sell for $1 billion. So if there's only one thing I'd leave you with, this idea that you should be chasing unicorns, in my opinion, is fucking stupid for all but the exceptions to the rule. And in my opinion, Silicon Valley is predominantly a stacked game. I think what Dave said is right. It is not across Sand Hill. It's really the same 10 VCs that are touching almost all of these. So I want to talk a little bit about why I chose Miami with that as a backdrop. The first question I got, everyone thought was taxes, and taxes for sure play a factor. I had a weird distinction. I sold my company on February 11th, I think it was, of 2012. And about 30 days after I sold the company, so I closed the transaction, I sold it, I knew what the deal was. I got a call from my accountant who said, hey, California introduced a new rule, but it's retroactive to before they actually introduced it. And so you now owe another $1 million in state tax, even though that law didn't exist when you sold the company. That type of weird mafioso shit may work for some, but for me it didn't sit well. And so that was one of the drivers. But that wasn't the major reason. I could have dealt with taxes. If I could consistently get $100 million exits in California and I couldn't get them in Florida, I would have stayed in California. But my view right now is the weird combination of really high burn rates is driving a really unhealthy culture. And when I started looking at Miami, I saw a few things that were interesting to me. The first is capital goes twice as far, if not 3 times as far. And so in that early stage, when you're not raising a lot of money and you're trying to make a lot of product progress, being able to raise a lot less money and get a lot further along has enormous amounts of value. The second thing I saw was great engineering talent. We were hiring mechanical engineers, electrical engineers, software engineers. We were seeing talent out of places like Motorola and Citrix that were as good as the talent we get in Silicon Valley, but they were half the cost. And so far, we haven't had a single person leave. The other thing for me is that Forbes named Miami the #1 place to live in America, and my early view of it is that's correct. It's an incredibly easy place to run a company from the standpoint of quality of life. It's easy to be able to sit, when I grew up in Rochester, New York, and there's pretty much, you can pick anywhere better than that by just throwing darts. But the reality is, if you look at a place like Miami, I can pick up the phone and call pretty much anyone in the Northeast right now from roughly November to April, and I've got a really high chance they're going to come and join the team. And then I think obviously the Latin America and Spanish and European access, one thing that people don't talk a lot about, being able to have overlap with European hours and work hours is incredibly helpful if you're actually running an international business. If any of you that have run, I had 23 offices when I was at Juniper, 23 countries in Juniper. We had 70 offices around the world. Trying to deal with a follow the sun model is really, really hard if you're the person supposed to be chasing the sun. So I think there's a real opportunity, but there's actually one thing that I thought was actually more important than all of these things, and that was surprising for me. Miami is probably the greatest culture I've seen of anywhere I've been in the country, of a culture that really wants you to win. When I first arrived here, I moved here in January full-time after spending most of 2014 traveling around the world. And 2 people, one in the room who's going to lose a step bet to me later this month, and then a second guy introduced me to basically every entrepreneur in Miami. And within a few weeks, I'd had lunch, dinner, or drinks with every one of them. A few weeks after that, most of them were close friends. These are meetings that would be almost impossible to get in Silicon Valley. People that have sold businesses for hundreds of millions, billions of dollars, really great entrepreneurs. And yet in Miami, people were stepping out of their way to actually make it easier. And I think that makes an enormous difference when you're trying to start a company. With all of that as a backdrop, I will say it's not perfect, though. When I first moved here, I needed office space. Now, I think we can all agree real estate agents are the lowest form of life when it comes to email frequency. And yet, I sent an email to the 3 incubators in town, and 3 weeks after I signed the deal with the only one that responded, the other 2 responded and said, hey, if you're looking for space, we'd love you to come by. 24-day email response time for office space. So really painful. I'm used to things happening in minutes or hours. To be able to have them go at that pace was absolutely brutal. There were a lot of things that went a lot slower than I was used to. That's probably been the biggest pain point. The second thing I'd say, and this is where I would disagree with Dave, there's a lot of people playing VC in Miami. And that's good, but it's also dangerous. And what I mean by that is, right now, it's actually not that hard in Miami, in my opinion, to get $100,000. There's enough people that I've met alone that can cut $100,000 checks very easily, and there's a lot of really credible people that can cut $100,000 checks. But here's the risk. Most late-stage VCs will travel if the business is at scale. Most early-stage VCs will not. And so the risk that you have is that you get that capital gulch in the middle where you get a business that's starting to get to scale. It's got its product out, it's starting to get interesting. It takes $500,000, $1 million in capital, and now it needs expansion capital. It needs 5 or 10 to start growing. And that capital just simply does not exist here. It's not in a B team, it's just there is no team. There's nobody that I've seen, with the possible one exception of Manny Medina, who came into the market, and he's in a very narrow, focused space, that are actually making bets. And that should scare the shit out of you if you're investors. Because if you don't have somebody cut the next set of checks, you've got a gap between the time you're going to invest and the time capital that will travel is going to invest. And a lot of businesses are going to die in that gulch. So I think, despite the challenges, I think there's an incredible window of opportunity in Miami right now to start businesses and fund businesses. I think that's going to be here for the next 7 to 10 years. But I believe that what will happen is what always happens. A bunch of 30 to 50-year-old white dudes in the same blue shirts and khaki pants are going to come back into the market, and returns will normalize as they always do. Thank you.